Hey everybody, hope you're doing well. My name is Kevin Lau and wanted to jump on this whiteboard show me for those of you that are around 50 and you've been busy raising children, putting them through high school and college, maybe even paying for a wedding or two. And now you're in this situation where you're like, okay, now we need to think about retiring at some point in time. And maybe you're not ready to retire today. You're loving what you do, but maybe you feel like, hey, in the next 5 or 10 years, I want to create an opportunity where we're work optional, meaning you're working because you want to, not because you need to save more and invest more. All right, so this episode is for you. This whiteboard show me is for you if you're in that situation where you just turned 50 and you really want to ramp up your wealth building path towards financial independence. So we're going to break down three opportunities. We'll start with the low hanging fruit, and this is related to catch up contributions. Sorry for my handwriting. It's not good, and that you're going to have to deal with it. But this is related to 401ks, 403bs, TSPs, IRAs, 457s. Okay, those are the most common. And so each of these has their own contribution limits, and some of these will have the opportunity to save a little bit more once you turn 50, or in some cases 55. HSA, I'll add at the end. That's what that says, HSA. So you can't read that? Come on. Number two, we're going to talk about optimizing your investments. Optimizing investments. And then number three, we will talk about using your home equity. Really downsizing is what we're talking about there. So why don't we dive into the first one? Okay, so catch-ups. All right, we're talking 2024. And just going to put a note here. These are catch-up contributions. It's not easy to write on this whiteboard, partially because I have to almost elevate my palm as I'm writing with my stylus pen. Otherwise, it catches like all these random dots, which I don't want to do that. My wife was getting really annoyed looking at my first whiteboard presentation because I kept having these little, so anyways, if you have any suggestions on a stylus pen or maybe it's a new device I need, but this is a new iPad, so I don't know. Okay, so 2024, we've got some contribution limits. And so, over here we've got one bucket, which is sort of your traditional qualified plans, 401ks, 403bs, TSPs, okay? And the contribution limit in 2024 for these accounts is 23,000. All right, this is how much you can contribute for the year. It says year 2024. Okay. And that's great. And this could go into Roth contributions. It could go into traditional contributions. It could also go into after-tax contributions. Okay, we'll talk about why that would make sense. But at a very high level, once you turn 50, there is what's called a catch-up contribution. And the catch-up limit for those of you that are 50 plus is $7,500. Okay, for the year. So if you add these two together, okay, we get a total of $30,500 that you can contribute to one of these qualified plans. Okay, and this is just the employee contribution. It doesn't include matching. I oftentimes hear that is that, I hear, hey, Kevin, yeah, maxing my 401k, I put in 13,000 and then my company matches me 10. So I'm putting in the full max of 23. No. The 23 is just the employee contribution. Now, there is another limit that I'm going to point out here, and that's the total contribution limit for these types of defined contribution plans. And that amount on an annual basis is $69,000 per year. But if you're over 50, we already talked about 7,500 is the catch up. So in this case, we've got a $76,500 a year limit into these defined contribution plans. So on one hand, we've got this opportunity to save more, okay? But on the other hand, what is this after-tax bucket here? Well, this will apply to you for a couple of different reasons. Number one, if you're self-employed, and maybe you're a business owner, and maybe you don't have any full-time employees, or maybe you have a handful of employees. Well, you might be taking advantage of employee contributions as an employee. Maybe you're paying yourself a salary, so you're contributing the max of 23,000, and then you're over 50, so you take advantage of this catch-up contribution of 7,500. But then look at the difference here. We've got the total amount that can go into these plans is 76,500 if you're over 50, but between your catch up and your contribution, that only equates to 30,500. Okay, what gives here? All right, where's this other 46? What about this other 46K? Can you just dump 46 grand into this after tax contribution? It depends, right? If you've got some employees, you're going to have some testing run to make sure that your plan isn't top heavy. But if you're the only employee, absolutely, you could potentially contribute an additional $46,000 into your after-tax 401k plan. Okay, so you might be thinking, well, why would I do that? Why wouldn't I just contribute to my brokerage account? Because there's something what's called an after-tax mega backdoor Roth 401k contribution. All right, so Google that. That's a mouthful, but basically this mega backdoor Roth 401k contribution allows you to contribute money after tax, okay, into this bucket, and then immediately turn around and convert those dollars into the Roth 401k. So regardless of what your total earned income is, which impacts your ability to contribute directly to a Roth IRA or maybe deduct traditional IRA, there is no income restrictions on who can contribute to this after-tax 401k and then convert to Roth or directly into the Roth 401k. There's no income limitations there, all right? So basically you have the opportunity as a business owner to put $76,500 mostly into the Roth 401k plan, if not all of it. And that's a big opportunity. That's a big planning opportunity. If you want to build up this Roth bucket as much as possible before you retire because you think taxes are going up down the road, this could be your ticket to getting a lot of money into the Roth side, without having to worry about the income restrictions on IRAs or Roth IRAs. Okay. But that's a whole nother conversation. And oh, by the way, this mega 401k, Roth 401k contribution could also apply for a highly compensated individual at a company. Maybe you work in big tech, or maybe you work in finance, or maybe you're in private equity and you earn a nice healthy salary. You can easily max out your employee contribution. You can easily max out the catch up, and you could do even more. Well, sometimes they have that opportunity to do this after tax mega backdoor Roth 401k contribution. And it may not give you the opportunity to contribute that full 46 to get to this number, right? But maybe they give you a number. They say, okay, based on the testing we've done in our 401k, your max is 26,000, okay, or whatever it might be. But the important thing is, if you're going to take advantage of that, make sure once it gets into this after-tax account that you are following the process to convert into the Roth. Otherwise, this is going to have tax-deferred growth as opposed to tax-free growth. Big deal. All right, and I'm going to just touch on the IRA side. I'm not going to go into too much detail on this because it's pretty simple here. Max contribution for 2024, we've got $7,000 per year, and that applies to both the IRA and the Roth IRA, and it is a combined number. So if you do 3,500 into your traditional IRA, you can do 3,500 into the Roth IRA. And if you're over 50, you get a whopping $1,000 catch-up. Okay. So that equals a total of 8,000. Okay. So yeah, really opportunity number one, the low-hanging fruit is take advantage of these catch-up contributions, take advantage of these potential opportunities to build up your savings for retirement, tax advantaged. Okay. I'll throw one other out here before I move on to the next slide, which is health savings accounts, or HSAs. Probably my favorite account to use to invest for retirement. Now, the key is, in order to qualify for an HSA, you need to have a high deductible health plan. And so just check with your HR department and say, hey, do I have a high deductible health plan? And if you do, you could potentially set up and contribute to a health savings account. Okay. And for individuals, the single contribution limit is 4150 for 2024. And then for married, or not, I'm sorry, not married, we'll say the family plan, because just because you're married doesn't mean you're on a family plan. So if you're on a family plan, then the cap is 7,750. Okay. But once you turn 55, sorry, I'm losing space here. Once you turn 55 in this case, then you get an additional $1,000 catch up. Okay. So take advantage of that. Once you turn 55, you can put a little bit more money into the HSA. So what's the benefit of the HSA? Well, if you're familiar with how a Roth works, you know that you have tax-free growth on the Roth as soon as those withdrawals are qualified. But the difference is, did you take a tax deduction when you made the Roth 401k contribution or the Roth IRA contribution? No, you did not. You did not take a tax deduction. You contributed on an after-tax basis, but then you have that tax-free growth. Traditional 401k is the opposite. Did you pay tax going into the account? No, you didn't. So you actually got a tax deduction on the front end, but then on the back end, that's when you're taxed as ordinary income. Okay, so it's tax deferred. Well, the HSA almost has the best of both worlds. Money going into the account gets a tax deduction. Okay, assuming you can qualify for a high deductible health plan, you can make that contribution. So you get the tax deduction on that regardless of your income. And then if you use the money for qualified healthcare expenses, then you can take the money out in the back end, also tax-free. So you have tax deductions, tax-free growth, tax-free distributions, the triple whammy. So that's why I love this account so much. Anyway, I digress. Number 2, optimizing your investments. Okay. So the traditional method of thinking that I find people have is that, let's say you are 50 years old and you're like, hey, I'd love to have the opportunity to retire at, let's say, 60. All right. And then we have this. Okay. So 60. Well, most people think, okay, well, from now until 60, I've got a 10-year time horizon. So I don't have a 20-year or 30-year time horizon like I did in my 20s and 30s. So now I need to get more conservative. Okay, the closer I get to that destination or the closer I get to this retirement date. And they don't really realize, well, just because you retired at 60 doesn't mean you need all of your money that year. You might need some of it, but you also need some money to grow to protect you when you're older. Longevity risk. And maybe you lived until 90. Okay. That's a 30-year time horizon in retirement. You're telling me that if you have a 30-year time horizon, you're not going to take a little bit of risk in order to protect inflation? We've already had inflation run rampant over the last couple of years. Inflation's a real risk for retirees. How do you protect against inflation? Investing in the stock market, right? So what I'm saying is, I'm not saying you need to be 100% in stocks at 60 just because you have a 30-year time horizon, but I don't think you should own your age in bonds, which is a traditional method of thinking. And so that individual would have maybe 40% in equities and then 60% in fixed income or FI. That's pretty conservative. And just because you're conservative also does not mean you're immune to market risk. I mean, look what happened in 2022. Interest rates went up, the value of bonds went down. And I have conservative investors that all of a sudden looked at their statements like, my performance is terrible. They come to me and they say, Kevin, what can you do about this? Or why did this happen? And I just tell them, well, you were pretty heavily exposed into fixed income, which is directly tied to interest rates. So we're going to have interest rate sensitivity. Obviously, equities have market volatility. So if earnings don't look good, we're into a recession, we're going through a slowdown, inflation's running hot, that's going to impact earnings, which is going to impact the stock prices of the companies in your equity portfolios. But over the long term, that's going to be the best opportunity to, again, hedge inflation. So what I'm telling you is that, maybe you're investing in some sort of target fund. Maybe it's like a 2035 target fund, and it's like, hey, 10 years from now, boom, that lines up with my retirement. It's very likely the closer you get to retirement, the more it's going to look like this, because it's going to go with that traditional method of thinking, which is own your age in bonds. And what I tell people is that don't get too conservative too quickly, because you don't need all of your money in year one. You need a small percentage of it, and then you need most of your money later in retirement. Okay? So hopefully that helps. Optimize those investments. that's going to give you the opportunity to maximize returns and also maximize the probability of success in achieving your retirement goal. Home equity is probably the most underutilized asset in retirees' balance sheets. And I'm not saying take a second mortgage and leverage that and buy Bitcoin. I'm not talking about that, but I'm saying, hey, maybe you're sitting up there in New York, right? And you're like, you know what, this house has been great to us. And, we even have a pool back there. We've got, a pool that was, came with the house back in the 90s when we built it. And, it's got some beautiful trees back there. These are trees. You're feeling pretty good about your home, and maybe the value is $1 million and maybe you have no debt on that house. But you're thinking, hey, you know what? We've saved 750,000 for retirement, which is pretty darn good. Okay, we've done okay, but you know what? Maybe we could have saved more, but it was hard. We had, we were raising kids. We put them through private school. We had to pay for college. This is expensive. We had to pay for their activities. They're in travel ball. It's just prices are crazy. Expenses are insane raising kids. All right, I have 3 of them, so I know. But maybe you've saved a little bit, but you feel like you're a little bit behind. And maybe you've been eyeing, this idea of, hey, maybe I kind of want to move to Florida, and sort of have that lifestyle. I want to buy a boat. I want to, have beautiful weather, endless summer, right? And you're looking at houses down there. You're like, man, I could buy a pretty darn nice home. Maybe it's even a brand new house. Okay, it also has a pool, but instead of the trees up there in New York, maybe now you got some nice palm trees, right? You're like, man, this is nice. No state income taxes. Oh, and the price tag on this house is 750K, right? So if I sell this one and I buy here, I've got a surplus of 250K. Obviously, I'm simplifying it. You've got closing costs, moving costs, taxes potentially. So, I'm oversimplifying things, but you could potentially create a cash infusion into your portfolio, and now you have $1 million that's liquid as opposed to 750. And I'm telling you right now, a 25% increase in your liquid assets does wonders when it comes to timing and retirement. That's the difference of you retiring at, let's say, 65 versus 60. Okay, it's a big deal, and so don't ignore it. And I'm not saying just sell your house just to take advantage of the home equity you've built over the last several decades. What I'm saying is, if you're thinking about a move, think about tapping into that home equity, right? Tap into that home equity in a positive way. Don't overspend on that retirement housing, especially if you're falling a little bit behind for retirement. Be smart with that money. Put that into account that's going to grow and it's going to make you interest, but it's also going to be tax efficient too. It's just, be really, really careful of just taking that 250 and plunking it in a 1-year CD and calling it a day because you don't really know what to do with it. That's not the way to go. That's not going to protect against inflation risk, and that's going to create a tax drag on your returns. Okay, so be strategic with that money, and that goes hand in hand with what we mentioned in number 2, which is optimizing your investments. Have a prep plan and a process for optimizing your investments. But what I'm saying is, you might be sitting on a gold mine in your home equity. You haven't really thought about it as an asset on your balance sheet. And this doesn't even have to apply just to moving out of state or to a different city. It could be saying, hey, maybe we don't need the 4,000 square foot house. Maybe we cut that in half. Maybe we get a 2,000 square foot house. And, maybe the price per square foot we can get in that home, maybe it's pretty comparable to the price per square foot you could sell your current home for. Well, that's potentially an increase in terms of money in your pocket by about 50%, right? I mean, that's significant. So, work with your advisor, work with your planner, and just have this conversation. And as you're preparing for retirement, this is a big conversation that we have with folks that are living in some of those higher cost areas. And like, hey, you know what? I probably couldn't retire here until I'm 70. I'd probably have to work until 70, maximize my Social Security, let my investments compound another 10 or 15 years. Or I could retire someone that's a little less expensive and retire earlier. I'd rather do that person because you don't know how long you're going to be in those go-go years. You don't know how long you're going to be able to enjoy your health in retirement. So take advantage of it and do it as quickly as possible. And I'm not saying just rush into retirement, but I'm saying be thoughtful, thinking about what you're retiring to, and then implement that financial plan that makes sense for you. So hopefully you found this helpful. I'm going to share this on my YouTube channel as well. So if you want to check that out, go to the Planning for Retirement Podcast YouTube channel. And so that's the name of my podcast as well. So we're all over wherever you have podcast subscriptions, whether it's Apple or Spotify. But now we're posting it on YouTube. And I'm also going to post this video there as well. And so hopefully you guys enjoyed it. And if you have any questions or thoughts, drop a comment right there on the YouTube channel. And also, we'd love to hear from you too. If you want to send me a note, you can connect with me on my YouTube channel as well. Have a great day.